In this lesson, we will explore how to compare actual result to budgeted expectation using variances analysis, a fundamental tool which is fundamental tool in financial performance management. So first, what is variance? Variance is the difference between actual and budgeted amounts. So always when we want to make analysis, we need to compare the actual data with the budgeted amount. And we get a difference, we call it variance. It can be positive or negative. So this will help us identify the areas where performance differs from expectations. So by doing analysis, we can identify the area of the performance. Are we perform well in the sales part, in the margin, in the cost of goods sold? Variance enables management to take corrective action and improve future planning. So usually within the organization, when they finish the first month or quarter, they do variances analysis to see the area that the management need to take corrective action in order to improve the future planning. If we see that in the first month that our sales is decreased, that there is a reason behind that, it can be that we don't have enough labor. We need to take immediate action to hire more people, or it can be related to lack of material to be sold. So here the management need to take immediately an action in order to avoid that in the future and to improve the future planning and to improve the future figures, especially for the sales and revenue. So we have different types of variances. We have total variance, which is overall difference between actual and budget. So if we see the profit and loss statement, we see the total. We compare the total variance between the actual sales and the budgeted sales. Then we go deeper where we look to materials, labor, and overhead. So here we compare the materials, budget versus actual, and see the difference. The same thing for labor and overhead. Then we move to step number 3, specific variances. And this is very important, where we go deeper, where we analyze the price. What is the variance between price? It can be, we start by looking for the sales. Is if we see that the sales decrease, it may be a reason behind the price. We are selling the product less than the budget. The selling price is less than the budget, or it can be the quantity. It can be also the rate. This is related to labor. Example, if we set in the budget that the hourly rate, it will be $10 per hour. And finally, when in the actual it's higher, it's $12. So that's mean we are paying more. So our product cost us more than expected in the budget. So we will go deeper in the next lesson.